Imagine a world where a flower could make you rich, or bankrupt you overnight. A world where people sold land, borrowed money, and risked everything for a single bloom. This is the story of the Dutch tulip bubble, the first major speculative crash in history. The year was 1636. The Dutch Republic was booming. Trade, banking, and commerce made Amsterdam the financial capital of Europe. Merchants, bankers, and investors were flush with cash. Money flowed like water, but along with prosperity came obsession. And the obsession was tulips. Tulips had arrived in Europe decades earlier, brought from the Ottoman Empire. Their exotic colors, bold patterns, and rare varieties made them symbols of wealth, status, and sophistication. The elite displayed them in gardens, painted them in art, and coveted them above almost anything else. But as rare as tulips were, people began to see money in petals. At first, tulips were simply luxury items. But soon, prices began to rise. Certain bulbs, especially the most unusual ones, were worth more than a skilled craftsman's annual salary. In some cases, a single tulip could cost more than a house in Amsterdam. This is where speculation began. Merchants realized that tulip prices were climbing. They didn't want to plant them or enjoy their beauty. They wanted to sell them at a higher price. And thus, tulip trading exploded. Markets formed in coffee houses and marketplaces. Contracts were drawn up. Buyers agreed to purchase bulbs months in advance, often without ever seeing them. This was known as futures trading. A trader could buy a bulb for a promise of payment months later, hoping the price would rise before delivery. The frenzy escalated quickly. Ordinary citizens, farmers, and even clerks began investing. People sold possessions, land, furniture, family heirlooms to buy tulip contracts. The market was driven by fear of missing out. Everyone believed prices would always go higher, and for a while they did. Some rare bulbs reached staggering sums. The Semper Augustus, a single flower with a unique striped pattern, reportedly sold for more than 10,000 guilders, enough to buy a luxurious house in Amsterdam. Newspapers and pamphlets chronicled the rising prices. Tulip mania became a social phenomenon. People boasted of their wealth, and the speculative frenzy fed on itself. But bubbles are fragile. By 1637, cracks began to show. Buyers slowed. Prices plateaued. Confidence wavered. When panic set in, the bubble burst. Suddenly, tulip contracts lost value. Bulbs that were worth a fortune became almost worthless. Buyers refused to honor agreements. Sellers couldn't find buyers. Families who had mortgaged homes or borrowed money to buy bulbs faced ruin. Banks were unaffected in the short term, but the shock rippled through the economy. Entire households lost fortunes. Merchants went bankrupt. Real estate deals fell apart. The city that had reveled in wealth now faced chaos. The Dutch tulip bubble is remembered today not just for its financial impact, but for its lessons on human psychology and markets. It revealed how greed, speculation, and herd behavior could drive prices far beyond intrinsic value. A flower, with no practical utility, became a vehicle for massive wealth and ruin. It also highlighted early forms of financial instruments. Futures contracts, margin trading, and speculative credit all existed during tulip mania. These tools, revolutionary at the time, became a warning of how modern markets could behave when unchecked. Economists today study tulip mania as a cautionary tale. It is an early example of a speculative bubble, a pattern that repeats throughout history. In 1637, tulips. In 1720, the South Sea bubble in England. In 1929, the stock market crash. In 2000, the dot-com bubble. In 2008, the housing crisis. Every bubble shares the same DNA: irrational exuberance, over-leveraging, and the belief that prices will rise indefinitely. Yet, there's more to the story than loss. Tulip mania coincided with one of the wealthiest periods in Dutch history. The Dutch Republic's trade, shipping, and banking systems continued to thrive. The bubble did not destroy the economy. It was contained, in part because the government did not intervene and speculation was concentrated in certain social circles. Still, the cultural and psychological impact was immense. Tulip mania entered art, literature, and conversation as a symbol of greed and folly. It became a metaphor for human behavior in markets, a story repeated in classrooms, boardrooms, and financial textbooks centuries later. Tulip mania also illustrates a fundamental truth about markets: value is subjective. The tulip's intrinsic value, a plant, was tiny. Its perceived value, fueled by scarcity and desire, became astronomical. This is the same principle that drives modern finance, from stocks to cryptocurrencies. Investors today face the same challenges as Dutch merchants in 1637, balancing risk, understanding fundamentals, and resisting the pull of the crowd. Human psychology has not changed. Markets remain as emotional as ever. In the end, the Dutch tulip bubble was more than a curiosity. It was history's first recorded market mania, a window into the intersection of wealth, culture, and human behavior. It showed that markets could be irrational, that speculation could create and destroy fortunes, and that money, even in the form of a flower, holds enormous power over society. The tulip's petals may have withered, but the lessons endured. From Amsterdam to Wall Street, from the South Sea to Bitcoin, the echoes of tulip mania remind us that speculation is timeless. Bubbles are inevitable, and human greed and desire for wealth are constants in financial history. So the next time you hear about a soaring market, a skyrocketing cryptocurrency, or a viral investment trend, remember the lesson of 1637: beauty can be costly, and speculation can be deadly. If you enjoyed this dive into the world's first financial bubble, like, subscribe, and join us as we explore more stories of money, madness, and history that shaped the world.